Welcome to Griffonomics.
Good to be back.
Today, we are going to dissect the invisible infrastructure of the United States. And I don't mean the concrete, the steel, or the power grid.
No, not the physical stuff.
I'm talking about the digital plumbing, the software layer that actually allows civilization to function when you're not looking.
It's the operating system for local government. That's really the best way to think about it.
And we are focusing on Tyler Technologies, ticker symbol TYL. And the reason this is hitting our desk today isn't just because they are a monopoly, which, let's be honest, they effectively are.
Oh, absolutely. A quiet one, but a monopoly nonetheless.
But because we're at a very specific collision point in their corporate life cycle, you have this company that, for all intents and purposes, owns the public sector market. They're aggressively forcing a migration to the cloud, which we'll get into.
Right.
And yet the stock just took a 5.4% hit on earnings?
It did. It created a classic conflict for the investor class, you know?
Yeah.
You have the Tyler 2030 roadmap, this grand vision promising massive cash flow generation down the line. And then you have the messy, noisy reality of Q4 2025.
So our mission today is to verify the thesis. Is this unsexy monopoly starting to show cracks? Was that earnings drop a real warning sign that the growth story is slowing down?
Or was it, as the bulls would argue, a gift? A buying opportunity wrapped in a lot of, frankly, confusing accounting noise,
We need to look at the math behind their cloud migration, the strategy they call the flip.
which is allegedly driving a 1.7x revenue uplift. We have to really kick the tires on that number.
We also need to look at their new acquisition, for the record, which I think is totally misunderstood by the broader market. It looks like a small deal, but I think it's a huge strategic piece.
It's a key part of the AI story they're building.
And we absolutely have to talk about the buyback. Because when a company authorizes $1 billion in repurchases right after a stock drop, well, they're sending a very loud signal.
It's a statement of confidence, for sure.
But let's start at the very beginning. Let's make this tangible. If you, listening right now, pay a parking ticket online, if you check a property assessment, if you call 911...
You are, in all likelihood, interacting with Tyler Technologies.
Right. So establish the dominance for us, because Tyler doesn't have the brand recognition of a Microsoft or a Salesforce, yet their market share is arguably stickier.
Oh, it's far stickier. It's a different kind of market share. Tyler has something like 45,000 installations across 15,000 distinct locations.
15,000 city halls, county courthouses.
Exactly. And we're talking all 50 states, Canada, the Caribbean, even Australia. But, you know, the raw numbers, they don't really tell the whole story. You have to understand who the customer is.
Local government.
Right. And what do we know about local government? They are, by nature, incredibly risk-averse. They are slow to change. And, crucially, they do not go out of business.
A county doesn't declare Chapter 11 and liquidate its assets. It can't.
Exactly. So your customer base is permanently solvent. That's a unique quality in the equity markets. Your customer will always be there to pay the bill.
So that's the stability. But where does the monopoly power, the moat, come from?
It's the switching cost. It's just astronomical. If you're a county clerk or a police dispatcher or a tax assessor, Tyler's software is your entire workflow. It is the repository for decades of mission-critical data.
All the court records, the marriage licenses, the criminal histories, the tax rolls.
It's all in there. To rip that out and replace it isn't just an IT headache. It is a massive career risk for the CIO of that county, for the mayor, for everyone involved.
If the new system fails, you could lose property records. You could fail to dispatch an ambulance. The consequences are real world, not just financial.
It's effectively impossible to switch without some sort of massive crisis or a multi-year, multi-million-dollar undertaking that no one has the stomach for. And that is why their gross client retention is consistently 98% or better.
Let's just pause on that number. 98%. That effectively means they start every single fiscal year with almost all of last year's revenue already locked in. The floor is already built.
It creates a predictability that very, very few SaaS companies can even dream of matching. I mean, even the best enterprise software companies, your Salesforces and Workdays, they usually hover around 90 to 95%. 98% is. It's practically tenure. Your customers are tenured.
But they aren't just one big blob of government software. I think that's a misconception. They have distinct segments, and the economics of those segments really differ. So let's break down the stack for everyone.
Right. The biggest piece of the pie, it's about 32% of revenue, is enterprise ERP.
Which is the bread and butter, the classic back office stuff.
Yes. Think financial management, human resources, procurement, revenue management. This is you know, the boring but essential software that ensures the school teachers get paid and the snowplows get bought on time.
Low beta, steady growth, it's the foundation.
Exactly. Then you have platform technologies. That's the second biggest chunk.
About 29%, I believe.
Yeah, just under 30. And this is a more dynamic segment. It includes the digital government solutions, so the consumer-facing websites where you go to pay your utility bill or register a business.
The stuff the average citizen actually sees and interacts with.
Right. And it also includes their data and insights division. This is where their low-code platforms sit, allowing governments to build their own simple applications without hiring a team of developers.
Okay, but the segment that always catches my eye, and specifically regarding this recent quarter, is justice and public safety.
It's about 22% of revenue, but you could argue it's the most mission-critical part of their entire portfolio.
I would absolutely argue that.
This is the software that covers court case management and emergency dispatch systems. If the ERP system goes down, payroll is late. That's a problem. If the dispatch system goes down,
People might die. It's that simple. The stakes are incredibly high.
and because of that, the barriers to entry are even higher. You can't just launch a startup in a garage and go sell dispatch software to the NYPD or the LA County Sheriff. You need decades of trust, certifications, security clearances.
It's an insurmountable moat for most companies, and you mentioned an acquisition in this space that we need to circle back to for the record.
Yes, that closed post-quarter, but it is absolutely vital for understanding the future of that justice segment and their whole AI strategy. It's a bigger deal than the price tag suggests.
Okay, we'll put a pin in that. But before we get there, I want to clarify the revenue model itself, because I think the old mental model of Tyler was, sell a big, expensive software license and then charge 20% maintenance fees forever. That model is dead, right?
It is dying. It's not quite dead, but the shift has been aggressive and decisive. Recurring revenue is now 89.4% of total revenue.
Almost 90%. That's a huge transformation.
It is. And within that recurring bucket, you have the main SaaS growth engine, which was up over 20% in Q4. That's where the cloud migration lives.
Okay.
But there's a third bucket that people often miss, and it's becoming more and more important, and that is transaction-based revenue.
The convenience fees, the stuff you see when you pay a bill online.
Right. And this is where Tyler starts to act almost like a fintech company. When a citizen pays a fee online, whether it's for a permit or a utility bill, Tyler takes a small cut of that transaction. It aligns Tyler's revenue directly with the economic activity level of the government, not just the IT budget.
That's a clever model. It grows without them having to sell a new software module. It just grows with the population and with inflation.
Precisely.
So we've established the monopoly status. We know the segments. We know how they make money. But a stable monopoly, it usually trades at a boring multiple, a utility company, for instance.
Right.
Tyler trades at a premium, a significant premium. And that premium is built on one specific narrative, the flip.
This is the strategic inflection point. There's the whole reason you own the stock today. It's the growth story.
So explain the mechanics of the flip for us. What is actually happening?
It's simply the migration of those legacy on-premise clients, the ones still paying those old 20% maintenance fees, to the modern cloud-hosted SaaS model.
And why does Wall Street care so much if the server is sitting in the county basement or in an Amazon Web Services data center?
Because of the uplift. It's an arbitrage play on their own customer base. When a client flips from that old maintenance model to the new SaaS model, Tyler captures a revenue uplift of 1.7 to 1.8 times.
Okay, let's pause on that math because it's critical. Just by changing the delivery model and the billing structure for the exact same customer, they can almost double the annual revenue from that account.
Correct. And that's just the baseline. That's the floor. If they can use that migration event as an opportunity to cross-sell additional modules or enhance functionality, well, the uplift explodes.
They cited a deal with the Idaho courts recently in the earnings call.
Right, I saw that in the transcript. That's the perfect example. By moving the entire Idaho court system to the cloud and layering on new functionality that they didn't have before, the revenue uplift wasn't 1.7x. It was 4x.
4 times the revenue from an existing locked-in client. That is just incredible operating leverage.
It is. It's found money. And the beauty of it is the customer wants to do it, or at least they are being convinced that they want to do it.
What's the pitch to the customer?
It's a strong one. It removes the cybersecurity burden from the county's small, overworked IT staff. It handles disaster recovery. It gives them access to new features and AI tools that only work in the cloud. They're no longer just convincing clients why they should move. The conversation has shifted to when they will move.
It's become an inevitability.
Yes.
But the big question for investors is timing. We've been talking about this cloud transition for years now. When does the wave actually crest? When do we see the maximum financial benefit?
Management have been very specific about this, which is helpful. They expect the peak of the migration curve, the point where they are converting the maximum number of clients per year, to hit in 2027 or 2028.
So we are climbing the mountain right now. We're a couple of years away from the peak.
We are on the steep part of the slope, and we have data to back that up from this last quarter. In Q4 2025, the annual contract value, the ACV, that was generated specifically from these flips rose 64.5%.
Wow. 64.5%. That's a massive acceleration.
It is. It confirms the thesis is playing out in real time. The momentum is clearly building. They are no longer just piloting this process. They are industrializing it. They have a playbook to move hundreds of clients a year.
And structurally, this must change Tyler's cost basis too, right? I mean, if you get everyone on one single version of the software in the cloud.
Oh, hugely. It's a massive long-term benefit. Right now, they're still supporting hundreds of different legacy versions of their software, sitting on-premise at all these different clients.
Yeah.
It's incredibly inefficient from an R&D perspective.
A nightmare for support teams.
Absolutely. But as they consolidate everyone onto a single multi-tenant cloud version, their R&D efficiency just goes through the roof. They write code once, and it deploys instantly to everyone. The cost to serve each additional customer plummets.
Okay, so the long-term thesis seems completely intact. The monopoly is secure. The cloud migration is accelerating. The math works. So let's get back to the central conflict. Why did the stock drop 5.4%? Let's get into the forensic accounting of this Q4 miss.
This is where we really have to separate the signal from the noise. It was a noisy quarter.
The headline numbers on the surface were bad. Revenue, $575.2 million. That missed Wall Street estimates by about $16 million.
Yeah, that's a decent-sized miss for a company that's usually this predictable. It gets your attention.
And the earnings per share, the EPS, came in at $2.64.
Missing estimates by 9 cents.
For a stock trading at over 40 times earnings, a 9-cent miss is usually a death sentence in the short term. The algorithms sell first and ask questions later. But you're arguing this wasn't a fundamental deterioration of the business.
Not at all. If you actually read the 10K and listen to the commentary on the earnings call, the entire miss was driven by two very specific, and I would argue, isolated events. The first was a contract dispute.
Okay, walk us through that. What happened?
They had to record a $9.7 million non-cash loss reserve. This was related to a specific project implementation where things obviously went sideways, either legally or operationally.
And that $9.7 million hits operating income directly. It's a pure drag on the bottom line.
It does. It pulls the margin down for the entire quarter. But here's the critical question you have to ask as a long-term investor. Is that a systemic failure? Is their sales process broken? Is their software failing across the board? Or is it a really bad day at the office with one specific, probably litigious client?
And the data suggests
All the other data, the retention, the cloud flips, the backlog, suggests it's a one-off. It's a write-off. It's ugly. It makes the quarter look bad, but it is not a trend.
Okay, so if we're doing the mental math, we add back that, let's call it $10 million to get a cleaner picture of operating income. What was the second factor? Because this one seems to have more lingering effects on the forward guidance.
The Texas termination.
Sounds like a Western movie.
It was a legacy payments contract in the state of Texas that was terminated. Now, this is important because it directly hit that transaction revenue line we talked about.
Right, but transaction revenue still grew 12.1%, though. That's not terrible.
It did, which is healthy in a vacuum.
Right.
But the key is that without that Texas loss, it would have been significantly higher. And the market hates deceleration. Losing a big state contract, on the surface, looks like deceleration.
And this bleeds into the 2026 guidance as well, which I think is what really spooked people.
It does. They are guiding for 2026 transaction revenue growth of only 5 to 7%.
Which feels really low, especially for a fintech-like business line.
It is low, but they were very explicit on the call. They stated that without the headwind from that Texas termination, the year-over-year comp, that guidance would have been 10 to 12%.
So we have a clear cause and effect. It's not that the entire payments market is suddenly slowing down. It's that they have a really tough year-over-year comparison because of one specific lost contract from years ago.
Exactly. The underlying growth rate, ex-Texas, is still in the double digits. But, and here's the paradox we promised at the top, while the P&L, the income statement, looks messy because of these write-offs and contract losses. Have you looked at the bank account?
This is the real story of the quarter. This is the blankest takeaway for this whole section, the free cash flow.
It is absolutely astonishing. Despite the headline earnings miss, free cash flow hit a record $236.9 million in the quarter.
$236 million in 90 days from a company that supposedly missed expectations.
Yes. And if you calculate the free cash flow margin on the revenue, it's 41.2%.
41%. A 41% free cash flow margin. That is elite tier. That is Adobe or Visa or Moody's territory. That's a fortress.
You almost never see companies miss earnings while simultaneously printing that much cash with that kind of efficiency. It tells me that the underlying economic engine, the cash-generating power of the business model, is actually running hotter than the GAAP earnings per share would suggest.
It's the ultimate proof that the noise, the non-cash write-offs, the contract dispute reserve really was just accounting noise. The cash is real.
Cash doesn't lie. Accounting can be messy, but the cash balance at the end of the quarter is the truth.
Okay. So if the core business is that healthy, that cash generative, where does the next leg of growth come from? We've talked about the cloud flip, that's the big one. But there's a buzzword that every company has to use now, and Tyler is no exception. AI.
But here is where Tyler is different. I think their AI story is one of the most credible and tangible ones out there.
Usually when we talk about AI in the software space, it's framed as a bit of a threat. You know, AI will write the code itself, or AI will make this process free and commoditize your software.
Right. Or it's just pure hype. We added a chatbot to our website, so please add 10 points to our PE multiple.
With Tyler, you're calling this a labor replacement moat. That's a very specific term.
Look at the macro environment for their customers. Local governments are struggling, not just financially in some cases, but structurally. They cannot hire people.
The silver tsunami. All the baby boomers are retiring from the civil service.
And Gen Z does not want to work as a data entry clerk in the county courthouse basement for $40,000 a year. So you have these massive, persistent staffing shortages in critical back-office roles.
Enter Tyler with a solution.
Tyler isn't selling AI as a nice-to-have tech feature. They are selling it as budget arbitrage.
Budget arbitrage. That is a key phrase. Unpack it for us.
Okay, so usually a software vendor, like Salesforce, they fight for a piece of the IP budget. The IT budget is small. In a government entity, it's maybe 3 to 5% of the total operational spend. It's a knife fight for a small pool of money.
Right.
But the personnel budget, the budget for salaries and benefits, that is huge. In most governments, it's 60, maybe 70% of the entire operating budget.
So Tyler is essentially raiding the payroll budget instead of the IT budget.
Exactly. They're going to the county manager and they're saying, look, you have 20 open positions for clerks that you haven't been able to fill for 2 years. Give us the budget for just 3 of those positions, and our AI document automation software will do the work of all 20 of those phantom employees.
And that solves the manager's problem immediately. They don't have to go through the painful interview process. They don't have to pay for healthcare or pensions.
It's an incredibly easy sell. The ROI is immediate and obvious, and we're seeing it in the actual deals they're signing. Look at the new deal with Hillsborough County, Florida.
I saw that one. It was $950,000 a year for document automation software.
Right, which sounds like a lot of money for a tool. But the county did the math themselves. They put out a press release. They expect to save $2 million annually in labor costs. That's overtime, temporary staff, and unfilled headcount.
So the ROI is instant. The software pays for itself in less than 6 months, and then it's pure savings for the county.
That is the new moat. It's not just our software is better, it's our software is digital labor that is cheaper, more reliable, and available 24/7. And this connects directly to that acquisition we flagged earlier, for the record.
Right. Let's get to that. They bought them right after the quarter closed, February 2nd, 2026.
The purchase price was $212.5 million in cash. Enterprise value was a bit higher, around $258 million.
Okay, so a decent-sized tuck-in. What exactly does For the Record do that's so special?
They are the leader in digital court recording. So the audio and video capture of everything that happens in a courtroom. But their secret sauce, the real IP, is their legal-grade AI speech-to-text engine.
Legal grade, meaning it's accurate enough to be certified as the official court transcript.
Exactly. It's not Siri dictating your text messages. It has to be virtually perfect to stand up in court. But now, think about the strategic fit. Tyler already owns the case management system in most of America's courtrooms. They own the text, the filings, the judge's orders, the docket. For the record, owns the audio and video of the actual trial proceeding.
So they are merging the video and audio record with the written case file record.
They're creating a single, searchable source of truth. They call it judicial intelligence. Imagine you're a judge writing an opinion. You want to check exactly what a witness said on day 3 of the trial. Instead of having to ask for a printed transcript or scrub through hours of video, you can just search the video file like a Word document. Show me where the defendant mentioned the red car.
And boom, it takes you to that precise timestamp in the video.
It connects the digital record to the case file in real time. And again, think about the labor arbitrage. Court reporters are incredibly scarce. It's a difficult job, and the workforce is aging. They're very expensive.
So this technology either replaces the person typing furiously in the corner, or it makes them vastly more efficient.
Or it supplements them. So one highly skilled reporter can manage and certify the transcripts from 5 different courtrooms simultaneously. It's an enormous efficiency play.
Yay.
And because Tyler already owns the case management software in 70% of these courts, the cross-sell is just so obvious.
It's a no-brainer. You already use our software to manage the court docket. Just click this button to add the video recording and AI transcription module.
Exactly. It increases the average revenue per user, the ARPU from their most critical clients, and it deepens that already formidable moat even further.
So AI is a clear tailwind. It's expanding their addressable market from IT budgets to personnel budgets. But there's another area where Tyler is getting really creative with their business model, and that's in payments. This feels like the legacy of their big NIC acquisition from a few years back really starting to pay off.
It is. That's exactly what it is. NIC was the specialist in state-level digital government. Tyler was the king of local government. The combination has allowed them to create these new hybrid models that neither company could have done alone.
The California State Parks deal is the poster child for this strategy.
It's a massive contract. It's valued at $200 million. But here's the twist. Tyler isn't sending California an invoice for $200 million.
So how are they getting paid?
Through transaction fees. They built and now operate the entire reservation system for all of California's state parks and campgrounds. Every single time you or I go online to book a campsite at Big Sur or Yosemite, Tyler gets a small cut of that transaction.
So they're essentially monetizing the tourism and leisure activity of the entire state of California.
Correct. And crucially, 93% of Tyler's payment revenue is recognized as gross revenue. That's an accounting term, but it's important. It means they take on the merchant risk, but they get to keep a much larger slice of the pie, the upside.
It aligns their incentives perfectly with the state's. The easier and better they make the user interface for booking a campsite, the more reservations get made, and the more money both they and the state of California make.
And the state loves it because they didn't have to lay out $50 or $100 million in capital expenditure to build a new website from scratch. It's a self-funding model powered by user fees.
Is this model scalable? Are there other big pools of government money they can tap into with this transaction model?
The big untapped market they're talking about constantly now is disbursements.
Government payouts, money going out and not coming in.
Right. Think about all the money the government sends out to people and businesses. Jury duty payments, tax refunds, vendor payments for services rendered, foster care stipends, Social Security benefits.
Right now, a huge amount of that is still done with paper checks mailed through the Postal Service.
It costs the government a fortune to print and mail millions of checks, and it's a huge fraud risk. Tyler is targeting what they estimate is a $31 billion untapped market for electronic government payouts.
$31 billion. That's the size of the total flow of money.
That's their estimate of the total addressable market. If they can build the infrastructure to digitize that flow, to push money directly to debit cards or bank accounts instead of mailing a check, they can take a small fee on billions and billions of dollars of transaction flow.
It just seems like everywhere you look, they are finding new ways to insert themselves and essentially tax the movement of government data or government money.
That is the textbook definition of a modern infrastructure business.
Okay, let's pivot to the shareholders. We've talked about the business, the strategy, the financials. How is management treating the stock and, by extension, the owners of the company? Section 6, capital allocation.
This, for me, was the strongest signal in the entire earnings report, more than the cash flow even.
The buyback.
The buyback. Management saw the stock drop 5% on the earnings news, and they did not flinch. They didn't panic. They acted. They went to their board and authorized a new $1 billion share repurchase plan.
$1 billion. For a company of this size, that is a very significant authorization.
It is aggressive confidence. They're essentially looking at the market and saying, you are wrong. Your algorithm sold our stock based on a noisy quarter. If you want to sell us your shares at this discounted price, we will gladly take every single one of them off your hands.
But do they have the balance sheet to actually support that? Or are they leveraging up, taking on new debt just to buy back stock?
No, the balance sheet is pristine, and it's getting stronger every quarter. They have been rapidly paying down the debt they took on for the big NIC acquisition a few years ago. In fact, their main convertible debt issue matures in March 2026.
Which is right around the corner.
They have more than enough cash and liquidity to handle that maturity and still aggressively execute this new buyback. They are essentially replacing a series of smaller, piecemeal authorizations with this massive $1 billion cannon. It's a clear signal of intent.
What about visibility for the rest of 2026? What are they telling us to expect in the guidance?
So this top line, they're guiding for revenue between $2.5 billion and $2.55 billion.
Which is solid, predictable growth.
But the number I always look at is the sauce growth. That's the engine. They're projecting 20.5% to 22.5% growth in SaaS revenue for the full year.
So the cloud engine, the flip engine, continues to roar ahead at over 20%.
And here's the locked-in factor that gives you confidence in that number. They noted on the call that 12% of that projected 20+% growth is already secured. It's in the bag.
How is it secured?
It comes from two places: the existing backlog of deals that have been signed but not yet implemented, and automatic price escalators built into their multi-year contracts.
Explain price escalators for us.
They're essentially inflation adjustments built directly into the contracts. Many of their multi-year SaaS contracts have automatic 5, 6, or 7% annual price increases baked in. No negotiation needed.
So they literally walk into the new year with 12% growth effectively guaranteed before the sales team even picks up the phone to sell a new deal.
That's the predictability you're paying for. That's why the valuation is high. You are paying a premium for certainty in an uncertain world.
Okay, let's bring this all home. The final section, the final verdict. We have this Tyler 2030 roadmap. What is the final destination they are steering us towards?
The targets are ambitious, but they feel achievable given the levers they can pull. By the year 2030, they want to hit $3.8 billion in annual revenue.
That's nearly doubling from where we are right now in about 5 or 6 years.
Correct. They want operating margins to expand to over 30%, up from the mid-20s today. And this is the big one. They are targeting $1 billion in annual free cash flow.
$1 billion of pure cash flow a year.
That is the definition of a world-class compounder. If they hit that number, the stock price will take care of itself over the long run.
But we have to be fair. We've been pretty bullish on the long-term story. What's the bear case? What could actually derail this train?
Valuation is the primary and most obvious risk. Even after the recent drop, the stock trades at over 40 times earnings. That is a multiple that is priced for perfection. There is no room for error.
So if growth slows down even a little bit, like we saw with the transaction revenue this quarter, the multiple can compress very quickly.
Exactly. If the market suddenly decides that Tyler is a 10% grower instead of a 15% grower, the stock could get cut in half and still not be considered statistically cheap.
And what about this DOGE factor we've been hearing about?
Right, the Department of Government Efficiency.
This federal push to cut waste and streamline government operations, is that a threat to their business?
It's the wild card. It's hard to predict. Management, of course, says it's a huge tailwind, that the political pressure to be more efficient will force slow-moving governments to finally buy modern software to automating tasks.
And that makes perfect sense logically.
But the bear argument is that it creates uncertainty and budget freezes. If a department head is afraid their budget is about to be slashed by the feds, they pause all major new projects. They don't sign a new 5-year, multi-million-dollar software contract.
We did see a little bit of that pausing behavior in their bookings in early 2025, didn't we?
We did. Bookings were a bit soft for a couple of quarters. If that uncertainty drags on, it could delay that flip timeline we talked about. Maybe the peak happens in 2029 instead of 2027.
So given those risks, where do you ultimately land on the stock today?
I view it as a high-conviction compounder. I think the Q4 miss was pure noise, a confluence of accounting one-offs and a single loss contract. The structural shift to the cloud and the emergence of AI as a genuine labor replacement solution are the real, durable signals.
It really is a compelling story when you lay it all out. You have a true monopoly that is actively modernizing its entire captive customer base and getting paid handsomely to do it.
And doing it with 98% retention. They almost never lose a customer.
It's really funny. We spend so much time in this industry on financial television hyping up the latest consumer AI app or the newest VR headset or, the electric car wars.
Because those things are exciting, they're
And
tangible.
they are. But here is Tyler Technologies just quietly running the digital operating system for the entire country in the background.
And making a 41% cash flow margin while they do it.
So, as we wrap up, here's a final thought for you to chew on. In a world where everyone is obsessed with AI writing poetry or generating fantastical images, the real durable money might just be in helping a county clerk in Hillsborough County, Florida, process a PDF file 5 minutes faster.
Efficiency isn't sexy, but it pays the bills, and then some.
It's not about the hype, it's about the plumbing. Thank you for listening to Griffonomics, Risk Defined, Portfolio Protected.